Welcome back to the Funding Blueprint. We're honored to have Eric Ferraro, managing partner of Fathom Law, join us. With over 25 years of experience in corporate, securities, and intellectual property law, Eric advises entrepreneurs, emerging growth, and middle market companies on corporate formation and governance, angel and venture capital financing, commercial and IP transactions, and merger and acquisitions. He also represents venture capital investors, private equity firms, and investment bankers in their investment and acquisition transactions. Beyond his legal expertise, Eric is a former digital media company founder and an active angel investor. This diverse background allows Eric to offer his clients a unique integrated counseling approach that balances legal protection and corporate best practices with business, technical, investment, and strategic considerations. Regularly recognized as a Northern Californian super lawyer in business and corporate law, Eric serves on the advisory boards of numerous notable technology companies. He's the co-creator of the popular Pitfalls venture competition and a regular panelist and mentor at a wide range of technology events and accelerators. Eric, welcome to the show.
Thanks so much. It's a pleasure to be here.
Awesome to have you here. So I want to kind of dive right in and kind of talk about safes and convertible notes, because these are really some of the prominent tools that are used as of today's day and age for fundraising. So one of the most major decisions a startup faces is how to structure its initial funding round. There are two popular instruments: SAFE, simple agreement for future equity, and convertible notes. And they've emerged as common choices nowadays. Both offer investors the opportunity to convert their investment into equity at a future date. But they differ in different key aspects. Understanding these differences is crucial for founders looking to make informed decisions about their fundraising strategy. So, Eric, with your experience, what are really the key distinctions between SAFEs and convertible notes, and when is one instrument more suitable than the other?
Yeah, it's a it's a good question. I mean, convertible notes have been around for a long time, and they come in a wide range of different shapes and sizes, and the terms can vary widely, which in and of itself makes them a little bit more complicated than safes. Both safes and convertible notes are good options for raising capital prior to a full-blown equity round, where a corporation would issue preferred stock, so a Series A round classically, or more modernly, we've introduced the Series Seed preferred stock financing, which is often the first preferred equity round. But convertible notes and safes are still quite commonly used in the earlier angel, and seed stages of the financing process. Convertible notes, as I said, have been around for a very long time. They go back to a time when the use case was really a classic bridge, right? A company needs to get some money to carry them from where they were until they closed a round. They were, in the early going, they weren't typically used as convertibles are today, which can last for years, right? Companies can raise money incrementally on these convertible instruments, safes included, for a very long time. And so that's created some issues, because convertible notes are ultimately a debt instrument. And like any promissory note, they have a number of terms that give the investor some protection, including the fact that it's a debt instrument, first of all, right? And so one of the differences between safes and convertible notes is that characteristic. Convertible notes are still considered to be debt instruments, and in the waterfall of a liquidation scenario where the company might have creditors, debt holders, of course, are going to have access to the company's assets prior to equity holders. Safes are treated like preferred equity, whereas convertible notes, again, are a debt instrument. In the real world, companies that, startups that fail often don't have any material assets, and so we don't think of it as a tremendous consideration when we're representing investors. On the company side, the SAFE has been introduced, much more recently as compared to convertible notes, and the intent there was to really streamline the process, because even a convertible note round these days can turn into quite a long and somewhat expensive process, just because there are so many variables and there's a lack of standardization with respect to convertible notes. So one of the biggest problems that we think about with convertible notes on the company side is that they, like any debt instrument, have a maturity date, right? So at some point, whether it's 12 months, 24 months, 36 months, at some point that convertible note matures. And then you have to ask yourself, what happens then? And there are really three possibilities as to what can happen on maturity. The most traditional consequence when any debt instrument matures is that you have to pay it back. But almost no startups are ever in a position to pay back early funding, right? That's not the intent. And most convertible debt investors have an equity mindset. They're not actually in it for the interest and to be paid back at the end of the loan, right? And so payback at the end of the maturity period is effectively a non-starter, right? So then you're talking about conversion, convertible note. Conversion into what? Now, the expectation with any convertible, SAFE or convertible note, is that it will convert into equity when the company has their next equity round. But what if the company doesn't have a next equity round and the note matures? Then you're stuck with the problem of deciding, well, do we actually run an equity round purely for the purpose of converting these notes into preferred stock, which is what the investors expected in the first place? But that's a very expensive process, even when you have new investment capital coming in. And in this hypothetical, there is no new capital. So that's effectively a non-starter. And the third option, which is what often happens, is that the notes then convert into common stock, which the companies have, right? They've issued common stock to the founders have issued common stock to themselves and their team, and presumably they have additional common stock, and if not, it can be authorized. So that's the sort of the quickest way to deal with conversion, but that's not usually what is in anyone's best interest. The investors, as startup investors, are expecting to get preferred equity, not common stock. Even if they're willing to accept common stock, there comes a question as to, like, well, how do you value that common stock? It shouldn't, if the convertible notes have a valuation cap, that cap is designed to reflect a preferred stock price and a relative discount to whatever the new investors would pay. So it's just complicated, right? And convertible notes, for that reason, are, at least in this part of the world, by which I mean San Francisco, Silicon Valley, maybe the kind of the West Coast tech sector, are falling into disfavor, certainly on the company side, and even on what I'll call the professional investor side, in favor of safes. We still see convertible notes used more commonly outside the Bay Area in smaller geographies, maybe where there's been less inroads made by the SAFE and traditional investors aren't quite as comfortable with them. But around here, we try not to do convertible note rounds for our company clients unless the circumstances really call for it. The SAFE, in contrast, is quite an elegant agreement. It's still a convertible security. So just like a convertible note, it has the primary features that are the same: a valuation cap or a stated discount to the price paid by the new investors in the preferred round. There's no maturity date, right? So the money comes into the company and potentially sits there in this sort of convertible phantom status forever, okay? And if and when there is an equity round, the SAFEs will convert into the equity issued in that round at their appropriate price as determined by the discount or the valuation cap. And if there isn't an equity round, then the SAFEs provide for what happens should the company get acquired, should the company dissolve, go public. Like, all of those outcomes are dealt with by the SAFE, and they're treated the same as preferred stock in all of those situations, including on a dissolution or liquidation of the company. So, pari passu, as we say, with the preferred stockholders. But generally speaking, they are much, much faster and easier for the company to issue. Not using up the investment dollars that they're raising on legal is really a good thing for for companies, and I think the best investors recognize that and are more comfortable using safes for that reason.
Great points. I want to kind of dig deeper into preferred stocks for a second because we talked about that. Now, everyone knows preferred stocks is a unique financial instrument that combines elements of both debt and equity. It offers investors a level of preference over common stockholders in terms of dividend payments and asset distribution in liquidation. However, unlike debt, preferred stock represents ownership in the company. So, what are the key differences between preferred stock and common stock? And what are the typical terms associated with preferred stocks, such as liquidation preference, anti-dilution, and participation rights?
We could talk about this for hours, but generally speaking, in most technology startups, and by startup I mean companies that are legitimate startups, a few people on the cap table to thousands of people on the cap table. We sort of use that term generally for all of the technology companies as they move through their journey to exit. But generally speaking, technology companies, startups are structured often as Delaware C corporations, and one of the features of a C corporation is that you can have multiple classes and series of stock. And so typically there are both common stock and preferred stock in technology companies, okay, venture-backed technology companies, because venture investors, as we discussed earlier, expect preferred stock. Why? It's preferred. It has various rights, preferences, privileges over the common stock. One way that I like to describe preferred stock metaphorically, you can think about it as a share of common stock that's wrapped with various insurance policies. And so most of the rights and preferences that go along with preferred stock really take effect or come into their own in the unfortunate circumstances where the company is not faring as well as expected. Okay, and so two of the most important features of preferred stock you touched on. They are the liquidation preference and the anti-dilution protections. Now, liquidation preference is simply a term that speaks to the minimum amount that a preferred stockholder will get on dissolution. You need to understand that in a healthy company that is continually raising money in each of its financing rounds at an up valuation, and then it ultimately exits at a further up valuation, whether by merger and acquisition or by IPO, common stock and preferred stock generally participate in the proceeds on a one-to-one basis, meaning that they each have the same weight in terms of proceed participation. Okay, and that's because when all preferred stock, when issued, is convertible into common stock, and at the end of the line, when a company is exiting, generally speaking, the preferred stock does convert to common, and it converts at a particular price, what we call a conversion price, or you can think of it as a conversion ratio, and that conversion ratio is generally 1-to-1. That's the ratio that's dictated by the conversion price when the preferred stock is issued. However, as I said, it has these insurance policies wrapped around it. One of them is a liquidation preference, okay, which says that, so let's say a company in its first equity round, and let's pretend there were no convertible, okay? Let's say a company sells preferred stock to investors for whatever price, and in the aggregate, those preferred investors have 20% of the company by way of their preferred stock, okay? So the common represents 80% at that point, and the preferred represents 20%. If that company were acquired, and let's use some dollars to make this hypothetical more understandable. Let's say that the preferred investors paid $2 million, okay, at a $8 million pre-money valuation or a $10 million post-money valuation, and that's how they ended up with 20%, right? So $2 million, they've got 20%. company's worth 10. Okay. If the company were sold the next day for $10 million, then 2 million would go to the preferred, 8 million would go to the common. If the company were sold for $20 million, the preferred would get 4 million and the common would get 16, right? And that's how it works in an upside exit. But what if the company were sold for $5 million the next day? Okay. Now we've said that the preferred has 20% on the cap table, right? But they have a liquidation preference, which generally speaking in an early stage round would be what we call a 1x non-participating liquidation preference. And so what that means is that the investors will get back at least 1 times their invested capital. Okay, so in a hypothetical where the company is sold for $5 million after the investors had put in $2 million to get their 20%, they would get back $2 million, right? So they would be getting 2 out of 5, which is 40%, not 20%, right? And so that's the insurance idea there, where the liquidation preference ensures that the investors will at least get back 1x their invested capital, notwithstanding their percentage participation on the cap table. Okay, and that's in a non-participating structure, meaning that they either get the better of their liquidation preference or what they would get participating on an as converted basis, like the common stock. Sometimes you see both, right? You see a participating liquidation preference, which means they first get their money back, then they participate. We typically don't see that in what we'll call sort of market early stage financing rounds. In late stage rounds, the rules break down a little bit. So that's how liquidation preference works. Okay, it can be participating, it could be non-participating, typically 1x in early stage financings. Sometimes in later stage, you'll see 2x, 3x, and other multiples. So a very, very important protection for investors. We talked about anti-dilution a little bit. Anti-dilution is an often misunderstood term because it doesn't mean as an investor that you won't be diluted. All investors get diluted as the company grows. What it does mean is that there should not be dilution for an investor if it's due to a down round, a price decrease, right? So anti-dilution is not ownership or equity stake protection, it's price protection. So it's a little bit complicated, harder to give you a real world example, but the idea behind anti-dilution protection is that if you were an investor, let's use the example we gave earlier, you invested $2 million at a particular price, you acquired 20% of the company, and then the company raises around a year later at a lower valuation. Okay, so those investors are paying a lower price. Then there is protection for the prior investors who will get an adjustment in that conversion price that we talked about. You don't actually get issued more stock, but you get an adjustment in your conversion price so that at the end of the line, when you are exiting and the preferred is converting to common stock, the 1-to-1 ratio is now different, right? And there are various formulas that can be used for this anti-dilution protection. The most common in kind of the early stage financing context is what we call broad-based weighted average anti-dilution, which attempts to balance the equities. And for instance, if a company raised $2 million at $1 a share, okay, and then it raised money later at 50 cents a share, but it only raised $10,000. It would be arguably unfair for the $2 million worth of investment to be ratcheted down to that price because the dilutive effect of that lower price is not so great because it's only $10,000 worth, right? So a broad-based weighted average formula takes into account the weighting of the amount of money raised, not just the naked price. Preferred stock has a lot of other features to it, dividends, as you mentioned, although in the real world, most tech company startups do not declare or issue dividends to their preferred or to their common shareholders. We really don't see it, and dividends can be tax inefficient for C corporations. So dividend issuance is not a big part of the venture capital ecosystem. Nonetheless, preferred stock, always gets at least the same dividend rights that the common gets, if not more. Sometimes they accrue, and there are other ways to think about dividends. Preferred stock also has various voting protections or rights. So typically what you'll see, again, using our hypothetical here, where you have the preferred stock representing 20% of the total equity in a company, okay, after a Series A round. So the preferred stock as a voting class is obviously a minority group, right? The common stock still controls 80% of the stock of the company. Nonetheless, the preferred shareholders will typically have what we call protective provisions. And those are in the company's certificate of incorporation, or charter as we call it. And they effectively say that the company may not take various actions without the affirmative consent of the preferred shareholders, or a majority of the preferred shareholders, voting as a separate class. Okay? And so certain corporate actions like authorizing more stock, putting the features and the price on your Series B round, or amending the certificate of incorporation, or increasing the number of shares in your equity compensation plan, taking on debt over certain limits. All of those will be subject to what is effectively a veto, if you will, in the hands of the preferred stock. And many other features like that. But again, it tends to be this, if you want to think about them as insurance policies or just sort of bundled rights, the preferred stock has a outsized hand on the wheel of the company so that the investors remain informed. And there's other rights. They typically have information rights and pro rata rights to increase their investment and maintain their proportionate share of the company, and so quite a long list, and they vary from deal to deal.
Right, that's solid points. I want to kind of go back and divert our attention to a second to convertible notes and safes, specifically valuation caps and discounts. So valuation caps and discounts, they're the key terms in the world of convertible notes and safes, and they offer a way to balance the uncertainty of early stage investing with the potential for significant returns. However, understanding how these terms work and their implications for both founders and investors can be a tad bit complex. So, Eric, with your experience, how do valuation caps and discounts function with safes and convertible notes? And what are some of the potential advantages and disadvantages for founders and investors? And how do these terms really impact the overall valuation of the company?
The idea behind a valuation cap or a discount is to give your early investors a better deal than your next investors. A lot of times, it's very hard to put a value on a company. Frankly, it's hard to value startups at any stage of growth, right? It's a little bit of a black art. And ultimately, what needs to be remembered is that the valuation, whether we're talking about pre-money or post-money or price per share, all of those are variables that, work in sync with one another. They are all negotiated prices or negotiated values, right? So it's in any particular financing round, you must know two variables and can solve for the third. The three variables are the price per share, or the valuation, okay, the amount of money being invested, and the resulting equity percentage. And so sometimes investors will say, I'll give you $1 million for 10%, okay? And based on the cap table, you can then derive the price or the valuation for the whole company. Sometimes investors will say, I'll give you $1 million at a $5 million post-money valuation. And from there, you can derive the percentage ownership, right? And so those are those three variables. However, the earlier a company is and the less traction it has in the market, the less its product is, fully iterated, or sometimes because the investors that are investing in early stage rounds are less sophisticated maybe than traditional venture investors who might be coming in later and might not have as much insight into how to properly value a company. The early investors are often willing to piggyback on the valuation set between the company and the venture investors in the equity round. And they're generally okay with what that, whatever that negotiated value is, understanding that venture investors will, of course, do a very good job negotiating for the best possible deal for them and for their limited partners. But the early stage investors want some better deal, some discount, if you will, to that price. So a discount is the easiest to understand. It simply is that, right? As the mentality of an early stage investor who would be investing in a safe or a convertible note with a discount is effectively saying, look, I trust that the venture investors who come in 6 months or 12 months from now are going to do a good job putting a price on the company, but I'm giving you capital to help you get there, and I want a better deal. So I'll take something that's 80% of the price that they pay, meaning a 20% discount. Okay? Valuation caps are just another way to arrive at a discount. However, they have a little bit more of a variable discount, right? So if an early stage investor says, I'll give you money, but I want a $5 million cap on my note or on the safe, then if you end up raising money at a $10 million valuation from your venture investors, a $5 million cap is going to equate to a 50% discount. If you raise money at a $6 million price from your new investors, that $5 million cap is only a 16% discount or whatever it is. And so a cap both throws off a discount that's determined by the delta between the new money price and the capped price, but it gives the investors a little bit more certainty that the price won't go beyond a certain point. Sometimes caps and discounts can be used together, in which case the investor gets the better of, right? I'll give you a $5 million cap, but I also want a 20% discount. And so that in that hypothetical, if you raise money at a $6 million valuation, the cap would not control because that was only throwing off a 16% discount. The 20% discount would kick in, and that would dictate the price paid by the conversion price of those convertibles.
Great points. Let's talk about tax for a second, because I know we mentioned it very, very briefly, but I want to dig a little bit deeper into it, specifically tax for safes and convertible notes. So, while the allure of securing investment is undeniable, the tax consequences of safes, convertible notes, and preferred stock can be complex and far-reaching. Now, these financial instruments have unique tax implications for both the company and its investors, and understanding these nuances is vital for effective financial planning and compliance. So, what are the primary tax implications for safes, convertible notes, and preferred stocks for both investors and startups?
Generally, the tax consequences of being an investor and purchasing a safe or a convertible note is generally the same. Okay, so you're making a capital investment. Let's assume that these convertibles will convert into equity at some point, right? So at the time of conversion of a safe into preferred stock or a convertible note into preferred stock, at that point, you've established your basis, right? Your basis for purposes of capital gain. Right? An investor is making an investment with their own after-tax dollars, right? So this is, there's no tax deferral or anything like that, right? I mean, investors are investing after income tax dollars. Okay, and so you're making an investment in an asset, the equity in the company. One thing for investors to understand, sometimes, in the decision tree, which is a complicated one that both investors and companies have to work on together, right? The structure of any round is something that is typically negotiated with the investors. it's investors generally want to make sure that they're getting the best tax treatment on their exit proceeds, right? That's the real driver behind all of it. Okay, so an investor who's investing after-tax dollars, the money that's being put in the company has already been taxed, right? So we're only now talking about what happens to tax on the potential growth of that. Okay, so that's capital gains. As most people know, there's long-term capital gains and short-term capital gains rates. Okay, so any investor would prefer to have long-term capital gain rates on their investment. While the investment is convertible, which is to say before and until it converts into equity, there is no clock running on the long-term capital gain holding period. Okay, so that doesn't start until the convertibles convert, safes and convertible notes. There's a little bit of an interest rate issue with convertible notes because they bear interest, and that interest is typically converted into equity along with the principal on a convertible note. Some tax advisors may conservatively say that the income accrual on the principal that has been invested would be subject to income tax because it's interest, and interest income is typically income and subject to income tax. But putting aside that one little potential differing issue, safes and convertible notes work the same, which is investors put their money in, it sits, as we said, in limbo until and unless there's a conversion event. On conversion, then it will start the long-term capital gain clock ticking, which is generally a year and a day. Okay, so if a convertible note or a safe converts into preferred stock on day one and the company is sold after another 365 days, then typically the investors will get long-term capital gain treatment on their investment, on the proceeds over and above their basis. Okay. There's also QSBS, which is modernly very, very important. Okay, and it's a huge reason that investors choose to invest in tech companies and C corporations in particular, because only C corporations are eligible to issue QSBS, which stands for Qualified Small Business Stock. Okay, most startups in the first few years, at least, of their life cycle are QSBs, Qualified Small Businesses. They have total asset value that's under $50 million. They are the right types of companies. They're not professional services businesses and certain other excluded businesses. And the stock that they issue, whether we're talking about common stock to founders, preferred stock to investors, common stock to stock option holders upon exercise of stock options and warrants, all of that stock typically in the early phases of a company is qualified small business stock. And for the past 10 years or so, it's been a very well understood feature of qualified small business stock that the capital gain on disposition of that qualified small business stock is excluded from capital gain taxation up to the greater of $10 million or 10 times your basis in the stock. Okay, so for a founder who starts a company and receives common stock, what we call founder stock on day one, when and if that company is sold, let's say 5-6 years later, and the founder, is going to get $50 million in real world money for that common stock, the first 10 million of that is likely going to be excluded from tax under the QSBS exclusion. A venture investor who puts $5 million into a company in its Series A or Series B round, should that company go on to become a unicorn and IPOs or is acquired for hundreds of millions of dollars, and let's say that $5 million investment turns into $100 million in return on investment, up to $50 million in that scenario might be excluded from gain because it's 10x your basis, and that was a $5 million basis. Right? So it's a very, very powerful thing. So investors want to make sure that they are investing in companies that are qualified small businesses and can make the representation that they are. And then they're going to also want to have certain controls. We talked about this previously with the protective provisions, right? So preferred investors are typically going to be very careful that the company doesn't do anything that might disqualify that stock from being qualified small business stock. Now the long-term capital gains clock, as we said earlier, is just 1 year, but the QSBS holding period is 5 years. Okay, so these are long-term investments. The whole idea behind the QSBS, tax incentive scheme is to, fund innovation and to make sure that there's a lot of free-flowing capital in the venture technology market to drive innovation and power the American economy, and that takes time, right? So the QSBS investors need to make sure that their money is at work for at least 5 years. Much more to say about QSBS and the nuances around it, but it's quite powerful and something that most investors should be aware of if they're not.
Great points. I think these are all important points from a tax perspective. I think I want to focus a little bit more on negotiation for a second, because like we talked about, safes, convertible notes, preferred stock. I want to talk about negotiation. Say you're presented a deal, right? You're given a deal by a firm or an individual investor. How do you negotiate the terms of that? So, negotiation in general, like securing investment is a critical milestone for any startup, but there's a negotiation process and it can be really daunting. So understanding the nuances of safes, convertible notes, and preferred stock is essential, but it's your negotiation skills that will truly determine the outcome. So what are the effective negotiation tactics for founders when they're dealing with the terms of safes, convertible notes, and preferred stock?
Well, I suppose there's no question that negotiation abilities and strategies play into it, but I think that most investments, first of all, there's a especially in the early stage, there's a fairly, I want to say, a generic or a standardized set of kind of starting terms, right? So, one thing that's true in the venture tech ecosystem is that there's an awful lot of doing things, by the book. Okay, these legal processes, and these are legal transactions, right? They take a lot of work, and they're typically driven as much by the lawyers on both sides of the deal as by the principals of the investor and the company. And there's a million small, issues that do get negotiated back and forth ad nauseum. But the starting point is often well understood. If we're talking about a safe, there's very little to negotiate with a safe. The whole idea of a safe, as we said earlier, is that it is this commoditized vanilla document, and the current versions of the safes that Y Combinator makes available on its website, which is the genesis of the safe instrument, says right on it, this safe has not been modified from its original form other than, these few variables, right? The price, or the valuation cap, the discount. There's a couple of different forms of the safe, but they're pretty standardized. Okay, so the only real negotiation when it comes to a safe is the cap, the discount, whether it contains pro rata rights, there's a few other features. There's an MFN, or most favored nations version of the safe, but pretty low set of terms to negotiate. The big negotiation is, will you invest, right? Getting the investors to believe in your vision and your product market strategy, and to choose you over the thousands of other companies that are hungry for capital. Convertible notes, as we said, there are more terms and features that need to be negotiated. We talked about some of what happens on maturity, what happens on an acquisition, what happens on qualified financing or the next equity round. Are there thresholds for those? So there's more variables in a convertible note than a safe, for sure, and those do get negotiated. I think a lot of that is mechanical negotiation or technical term negotiation, and we, as counsel for If we're representing the company, we'll advise them, and the investors' lawyers will make, recommendations about those terms to the investors. And ultimately, that's it's a negotiation between the principals and the lawyers, and it's, sort of business terms, sort of technical terms. When you get into a preferred round, obviously there's just so much more to negotiate. Preferred stock financing is often a long and drawn out process, even with the best of intentions to do it quick and get it done, at a low cost. There's a lot of moving parts there, and they typically take, a couple of months and, many tens of thousands to do right. And sure, there's a lot of negotiation. You'll find that, like, as the company grows and their cap table gets more complicated, they've got different convertibles outstanding, they've got some notes, they've got safes with different caps, different discounts, they have an equity compensation plan, they've made promises about equity to various people, they haven't actually issued the stock options to conform to those promises because their 409A valuation isn't up to date. And so there's just all these issues that you have to think about and figure out, how are we going to deal with them in this financing, right? Will the investors contribute sort of on a post-money basis to making equity grants, or do they want all of the stock that needs to be issued to various recipients to be in the pre-money, right, factored into the price per share that they're going to pay? So a lot more mechanical negotiation. But I think stepping back from all of that, which is largely, at the hands of the lawyers, right? We spend just a tremendous amount of time working with the other side. Okay, if we're representing the venture fund, we're working with company counsel, and if we're representing the company, we're working with investor counsel to make sure that the pro forma, right, the version of the cap table that shows how everything is going to be at the closing is exactly how everybody expects it to be, and the pricing, artifacts are all dealt with, and the discounts and the caps and the interest on the notes, and promised equity and warrant coverage and refreshing the equity compensation plan as part of the closing. And all of that is a highly mechanical set of negotiations that are driven quite a bit by the lawyers. Behind all of that, and often before we get involved in any material way, the company has been negotiating in principle with the investors, right? This is why you should invest in us. Making the pitch, making the presentation. This is our vision. This is what we're doing. This is what our tech looks like. This is how we're going to go to market. This is how we expect to generate customers. What are our customer acquisition costs? What are our, unit economics, right? So all of that, you can think about it as negotiation or as marketing, but the objective, of course, on the company side is to make a compelling presentation to investors to get them to want to invest, right? Then the negotiation is around how much. How much will you invest? Will you be the lead investor, or are you trying to negotiate with a syndicate of other investors to round out a financing to, whatever the maximum offering amount is, $5 million or $10 million? So all sorts of negotiation and, sort of marketing rolled together into one. But I think we typically think about it in terms of like the negotiation or the marketing around the business, ultimately trying to get the investors to believe in the vision and want to put capital behind it and pour gasoline on that fire, right? And then the technical negotiation, where the lawyers on both sides are surfacing issues as they see them, presenting them to their clients and saying, hey, let's think about this, right? What's going to happen with, you made these promises to these 3 people for equity. They're not on the cap table. Are the investors going to be frustrated if we close and then you immediately issue a bunch of equity to them, and now there's much less left in your equity compensation plan than they expected, right? So those types of negotiations sort of happen in a serial manner as we go through a transaction and discover all the issues that need to be surfaced and kicked around.
This is awesome. I have to say, I learned a lot, and I'm sure our audience will definitely stand to benefit a lot from this episode. So, thank you really for taking the time, Eric, to join us. So, thank you for joining us on today's episode. We hope you gained valuable insights into the world of safes, convertible notes, and preferred stock. Special thanks to our guest, Eric Ferraro, for sharing his expertise and shedding light on these essential topics. If you want to learn more about Eric and the incredible work that he's doing at Fathom Law, be sure to check out their website and social media in the show notes. Don't forget to subscribe to our podcast for more expert advice and startup stories. And until next time.